Welcome to the tutorial on departmental accounts. What is the necessity of preparing departmental accounts? Whenever there are several departments in a company for performing separate types of functions, in that case, to find out the efficiencies of those departments based on the results, we need to prepare the departmental accounts. That means functions are done by several departments. In that case, based on the results of those departments, we can evaluate the efficiencies based on the departmental accounts. What are the advantages of departmental accounts? If we prepare the departmental accounts, we can evaluate the performance of the department based on the results, as well as we can measure the growth potential of each department by comparing the performance of previous year with the present year, as well as we can justify the investment on each department. I mean, we can justify the capital outlay that was done on each department, as well as we can apply our judgment about the efficiency. We can calculate the stock turnover ratio of each department, by which we can justify the efficiency. And lastly, we can prepare the plan for each department for the purpose of controlling the department, and that can be done if we prepare the departmental accounts. What are the methods of departmental accounts? We can see there are two methods for keeping the departmental accounts. The first one is accounts of all departments are kept in one book only. In that case, we prepare the departmental accounts on subsidiary ledger books. After that, we accumulate the balances in a ledger. And on the other hand, the other method of keeping accounts for department is separate set of books are kept for each department. Whenever we have a separate set of books, we can complete the stock accounts of goods received from or transferred to other departments, or as also sales. In that case, we need to find out the basis for allocation of common expense among the different departments. To find out the separate departmental net profit in addition to the gross profit. That means there are two methods. First one is account of all departments are kept in one book only. On the other hand, we can maintain separate set of books for each department. Whenever we maintain separate set of books for each department, in that case we need to allocate the common expenditure on different departments. In that case, we need to find out the basis of allocation of common expenditure among the different departments. We can see expenses should be allocated among different departments on a rational basis. While preparing the departmental accounts, individual identifiable expenses can be easily charged to the respective department, but whenever there are common expenses, I mean the common expense indicates the expense which give benefit to all department. In that case, the common expenses should be allocated or distributed among the departments on some equitable basis. So here is a diagram which is depicting that we can allocate the common expense based on the equitable basis or suitable basis. But if there are some expense which can be easily traced or identified for any department, we can directly charge that expense to the department. But whenever there are common expenses, we need to allocate the common expenses to the respective department based on the equitable basis or rational basis. We can see there are some example for the allocation of common expense, we can see the rent, rates or taxes can be allocated on the departments based on the floor area occupied by each department. The lighting and heating expense can be allocated based on the consumption of energy by each department. The selling expense can be allocated based on the sales of each department. The carriage inward or discount received can be allocated based on the purchases of each department. The wages and salaries could be allocated based on the time devoted to each department by the employees. The depreciation, insurance, repairs, maintenance of capital assets can be allocated based on the value of assets of each department. The administrative and other expenses can be allocated based on the time basis or equally among all departments. The labor welfare expense can be allocated based on the number of employees belongs to each department. The provident fund contributions can be allocated based on the wages and salaries of each department. Broadly, there are two types of department: dependent department and independent department. The dependent department transfer goods from one department to another department for further processing. In that case, the finished product or ultimate output of one department becomes the raw material or input for other department, and this transfer may be done at cost price or may be based on the selling price. The price at which this is done is known as transfer price. The dependent department transfer the product and the price charged on those transferred goods are known as transfer price. In this department, the unloading here, the unloading means the unrealized profit is required if the transfer price is having a profit element. The method of eliminating unrealized profit is being discussed in the succeeding slides. But on the other hand, the independent department work independently of each other and have negligible interdepartment transfer. That means independent department don't transfer any product to other department, but on the other hand, the dependent department transfer their goods to next department. That is why if the price includes the profit, in that case the department should find out the unrealized profit that should be presented in a proper way in the income statement as well as in the statement of financial position. As you can see, whenever there are dependent department, there are interdepartmental transfer. Whenever goods and service are provided by one department to another, their cost should be separately recorded and charged to the department benefiting thereby and credited to that providing the goods and services. The totals of such benefits should be disclosed in the departmental profit and loss account to distinguish them from other items of expenditure. And what are the basis of interdepartmental transfer? We can transfer the products on cost basis or based on market price or based on cost plus profit price. So this is the diagram which is depicting the transfer price and finding out the unrealized profit. We can see whenever there is a interdepartmental transfer on cost, there is no unrealized profit, and whenever the interdepartmental transfer occurs based on market price, if the market price is lower than cost, then there is no unrealized profit, but if the market price is higher than the cost, there is a unrealized profit. And we have to eliminate the unrealized profit from the inventory, as well as we have to adjust this unrealized profit by showing in the proper side of profit and loss account. On the other hand, if we transfer the product from one department to other department by adding profit with the cost, in the same way there are unrealized profit that should be eliminated from the inventory and that should be adjusted in the profit and loss account. we have to eliminate the unrealized profit whenever the transfer price have profit. That means when the profit is added in the interdepartmental transfer, the loading included in the unsold inventory should be excluded before preparing the final accounts. That means whenever we are transferring product with the profit, and whenever there is any unsold inventory, in that case, on those unsold inventory there may be some unrealized profit which should be eliminated. And how we can calculate the unrealized profit or stock reserve? Unrealized profit included in the unsold stock at the end of accounting period is eliminated by creating an appropriate stock reserve by debiting the combined profit and loss account. The amount of stock reserve can be calculated by this formula. We can see transfer price of unsold stock multiplied by profit included in the transfer price divided by transfer price. And this formula can be easily understood from an example. In the next slide, we can see there is an illustration to understand the calculation of a stock reserve or unrealized profit. Suppose goods are transferred from Department P to Department Q at a price 50% above cost. That means there are some profit with the transfer price. If the closing stock of Department Q is 27,000, then what would be the stock reserve? As we can see, this is the formula for calculating the stock reserve. So here, this is the unsold stock. So the amount of unsold stock is 27,000. So the transfer price of unsold stock should be written here. We can see this is the transfer price of unsold stock. And you can see the cost price is absent here, but there is an indication that the transfer price occurred with 50% above cost. That means suppose the cost is 100. If the cost is 100, the transfer price is 150 because the transfer price occurred adding the 50% above the cost. That means if the cost is 100, then the profit is 50, then the transfer price is 150. In this scenario, the stock reserve would be here. We have to show the transfer price of unsold stock, which is 27,000. We have written here, and this is the transfer price 150, and this is the profit in the transfer price, which is 50. After the calculation, we can see the amount of stock reserve or unrealized profit is 9,000. That means on this 27,000 unsold stock, there are 9,000 stock reserve or unrealized profit, and this unrealized profit should be presented in a proper way in the income statement as well as in the statement of financial position. And for that purpose, we need to adjust by proper journalizing. As you can see, the journal entry for stock reserve or unrealized profit. So whenever you are eliminating the unrealized profit, the journal should be profit and loss account debit and stock reserve credit. So this journal should be made at the end of the accounting period, but at the beginning of the next accounting period, we have to adjust the stock reserve as stock reserve debit and profit and loss account credit. And now we are going to see how to present this unrealized profit in the statement of financial position. As you can see, the stock reserve or unrealized profit should be deducted from the stock or inventory in the statement of financial position. So these are the discussion on the theory part on departmental accounts, and this is the first tutorial. In the next tutorial, we will see how to prepare the departmental accounts through an illustration. Thank you.